Behind the thrilling rides and family fun, a colossal amusement park company has been grappling with financial turmoil for decades, leading to abandoned parks and a shocking merger that no one saw coming. There's a good chance you've either visited or driven past a Six Flags amusement park. Their presence across the United States has been enormous, often outpacing other theme park operators like Disney, Universal, and Cedar Fair in the sheer number of rides and overall park area. In fact, for a time, it was the largest theme park operator in the world, with many of its parks cherished by fans. Yet, unlike those other industry giants, Six Flags has been plagued by financial difficulties for decades, seemingly caught in a revolving door of corporate owners making questionable decisions. There was even a period when this financial pressure became so severe that the company declared bankruptcy, abandoning entire theme parks or demolishing them in its wake. Let's delve into the history behind this iconic amusement park company, explore why it has struggled for so long, and discover its current trajectory, especially in light of the headline-grabbing merger with its once fierce competitor. This is the story of Six Flags. In 1955, Walt Disney and his company opened Disneyland in Anaheim, California, arguably one of the world's first theme parks. It was a massive success, demonstrating how popular and profitable such an amusement park enterprise could be. Its triumph inspired developers to replicate this type of project elsewhere. One such aspiring developer was Angus Wynn, a 47-year-old Texas-based businessman primarily involved in large-scale residential properties. Wynn and his associates were seeking ways to finance a new industrial park, and observing Disneyland's success in California, he theorized that building his own theme park could generate the necessary revenue for his other ventures. With a site selected just west of Dallas in Arlington, Texas, Wynn built Six Flags Over Texas, which opened in August 1961. It was a humble park, sharing many similarities with Disneyland, both in its shape, its layout of divided lands, themed attractions, and even a train running the perimeter. These lands were divided into 6 different nations that historically held sovereignty over the state of Texas, and flags for each of these governments flew over the park, which is where Six Flags got its name. The park was an immediate hit, attracting several 100,000 people. In fact, it was much more successful than originally anticipated, seen as a nearby, more affordable alternative to Disneyland, offering its own roster of fun attractions, a clear choice for many locals. With this overwhelming interest and a substantial amount of cash flowing in, Wynn had an epiphany. Perhaps, instead of operating an amusement park for just a couple of years before building an industrial development over it, the park could become a long-term business in its own right. So, he continued to expand the park with new rides, creating even more appeal, which in turn led to ever-growing attendance. This was no half-hearted effort. They were investing in new attractions designed to thrill guests, such as introducing the world's first log flume ride and an advanced steel mine train coaster, one of the first in America. However, Angus Wynn ultimately wasn't suited for the theme park business, and in 1966, he decided to cash out, selling Six Flags to the Pennsylvania Railroad Company, which acquired the controlling shares. With a new, deep-pocketed parent corporation, they quickly sought to expand further, opening another park called Six Flags Over Georgia a year later. With even more investors joining and taking larger ownership stakes, yet another park was built and opened in 1971, this one just outside St. Louis, named Six Flags Over Mid-America. These were all popular parks, and the company aimed to continue its expansion efforts. However, their strategy moving forward wasn't to invest significant capital in constructing brand new properties. Instead, their approach was to acquire existing parks. This basically became Six Flags' guiding growth philosophy. They first applied this in 1975 with Astroworld in Houston, Texas, and continued with Great Adventure in Jackson, New Jersey, and Magic Mountain in Valencia, California. All 3 were independent properties, each having opened within the preceding 11 years. This marked a successful growth period for Six Flags throughout the 1970s and encouraged management to press on. Though, it must be noted, consistent management was never truly a hallmark of the Six Flags Corporation. New majority shareholders would take over in a revolving door fashion, most with absolutely no experience in the theme park business, a trend already observed with Penn Central. This pattern continued with the Bally Manufacturing Corporation in 1982, which purchased the controlling shares of Six Flags from Penn Central for just over $147 million, a relatively small purchase price for a company that analysts estimated was generating around $310 million with a $35 million profit. The company didn't stand still. They continued to innovate, opening the world's first water rapid ride at Astroworld and Six Flags Great America north of Chicago. They also began experimenting with characters in their parks, having just acquired the theme park rights for the Looney Tunes characters. This was an excellent way to appeal to families and better compete with Disney, which by this point had a massive property in Central Florida with 2 major theme parks and a third on the way. But Bally wouldn't hold on to the company for much longer. In 1987, a private equity firm, Westray Capital Corporation, purchased the company for $617 million through a leveraged buyout, demonstrating how valuable the Six Flags brand was becoming, seeing a $470 million valuation increase in just 5 years. Six Flags offered quality thrills in a clean, inviting, and amusement-filled environment that was both cheaper than Disney and closer to home. Six Flags parks weren't necessarily destinations guests would fly or travel long distances to visit, but they provided comfortable and fun environments for those who didn't want to or couldn't afford to commit to traveling all the way to Disney. They were regional theme parks. In fact, Six Flags was now the largest chain in terms of size in the entire country, attracting over 17 million combined guests with revenue of around $400 million. Industry titan Time Warner wanted a piece of this success and began buying up shares, becoming a large shareholder for the company. This further strengthened their partnership with Warner Brothers and the Looney Tunes brand. It was now in their best interest for the company to succeed, and Six Flags parks began hosting Looney Tunes-themed events. The company continued to open new attractions across its portfolio, including some larger roller coasters like Ultra Twister at Astroworld, Viper at Magic Mountain, and Texas Giant, the world's tallest wooden roller coaster, which opened at Six Flags Over Texas. This also cemented the brand as a place for theme park firsts, a utopia for thrill seekers, offering some of America's most intense experiences, particularly appealing to local residents. However, once again, the company would change hands, this time being split between 3 major shareholders, 2 investment firms owning a combined 50%, and Time Warner owning the other half. While Six Flags was growing and appeared to be a stable brand, the truth was it was riddled with high-interest debt and had little cash in reserves. The company also had some duds throughout the 1970s. They owned a few wax museums, one even in Orlando, Florida. Then there was Six Flags Atlantis, where they had purchased a half-finished water park in Hollywood, Florida, which only lasted for 9 years. There was also the extremely disastrous Autoworld in Flint, Michigan. It cost $70 million to build and only lasted for 6 months before switching to seasonal openings, then being demolished altogether 10 years later. Six Flags Power Plant, a genuinely neat and creative attempt at an indoor theme park located in Baltimore, also lasted only a few years. The point is, Six Flags didn't always get it right, and all this debt was weighing down what could be a very profitable company ripe for growth. So, when this new deal went down, these massive investment firms, along with Warner, injected investment into the parks and provided a significant amount of safety net cash to keep them afloat. The newly formed Six Flags Theme Parks Inc. was a brand new entity, once again hungry for growth. Warner had already invested $200 million into the brand, and the company introduced a few new popular attractions through the early 1990s, such as the Right Stuff Mach 1 simulator ride, Z-Force, and the very popular and technologically advanced Batman, the ride. But it wasn't just thrills, the company opened other attractions and even a water park across the highway from Six Flags Over Texas. All of this created an attractive proposition for potential theme park guests, drawing them in with excellent marketing and a genuinely good portfolio of rides and attractions. This was also a time when Six Flags had become a culturally significant brand, with its parks very popular among young adults and even celebrities, who hosted star-studded events or birthday parties, many of which took place at Magic Mountain. In 1993, Time Warner ultimately opted to buy out the other investors and take 100% control over the company, bringing it under their corporate umbrella. Across all their parks, combined annual attendance was now an impressive 22 million people. 2 years later, in 1995, Time Warner apparently decided to relinquish full control, selling 51% of their shares to an investment company and spinning it off as its own corporation. By doing this, Time Warner offloaded a lot of its own corporate debt with the departing company. This change in leadership would only last a few years and saw some minor alterations. By 1998, Six Flags was in the crosshairs of yet another potential corporate takeover. This time, it was Premier Parks. Premier, formerly known as the Tierco Group, was a large real estate development company that, much like Six Flags, pivoted into an amusement park company after successfully acquiring other small theme parks. By the 1990s, they were aggressively acquiring other entertainment companies and major theme park assets like Darien Lake, Riverside Park, and Geauga Lake. They were looking to grow and greatly admired the brand Six Flags had built. And this was no April Fool's joke. Premier Parks acquired Six Flags on April 1, 1998, for $1.8 billion. However, this deal carried significant risk. It was the largest acquisition deal in theme park history, and Premier would put up over $700 million in cash, though they would also take out over $800 million in debt. They were gambling everything on the prospect that Six Flags would generate enough cash to pay it off in the future, and this was already on top of the decades of existing debt the company was saddled with. This deal also meant that Six Flags would be taking on a sizable portfolio of amusement parks that Premier already owned. Over the next couple of years, many of those parks would be slowly rebranded into Six Flags. Geauga Lake became Six Flags Ohio, Marine World became Six Flags Marine World, and Kentucky Kingdom became Six Flags Kentucky Kingdom, to name just a few. The company had more than doubled in size, and Premier had gone all in on the Six Flags brand, dissolving their own name and operating everything under Six Flags Theme Parks Inc. Executives from Premier believed the company needed some fixing, as they thought past owners had not provided enough capital for new attractions and didn't market enough to families. They were also making efforts outside of America, expanding with Six Flags Mexico, a park in Montreal, Canada, and even overseas with Six Flags Holland by 2001. They also grew their Six Flags Ohio park after acquiring the SeaWorld across the lake, turning it into one massive property. In fact, it became the largest theme park in the world, though a costly one to operate. New rides were opening across the chain, as well as some notable coasters like Goliath at Magic Mountain, the longest and fastest closed-circuit coaster in the world, the unique Superman, Krypton Coaster, a floorless coaster at Fiesta Texas, Superman, Ride of Steel at Six Flags America, Nitro at Great Adventure, regarded as one of the best roller coasters in the world, and Superman, El Ultimo Escape, the tallest and fastest coaster in Latin America. These were all innovative and record-breaking attractions, with many more opening during this time. Six Flags was also now hosting Fright Fest and Winter Lights, popular seasonal events. Six Flags New Orleans was added during this period, and the entire company seemed to have injected a lot of excitement into the brand. It was truly a great time to be an amusement park fan. In terms of national brand name recognition, Six Flags was right up there with, and even edging out, Disney. A recent study showed Six Flags scored higher than even Disney World, SeaWorld, and Disneyland in aided awareness, and Six Flags even edged both Disney parks as the favorite theme park. But despite all the excitement surrounding these investments, the company's financial situation was not looking good. Six Flags had continued to spend so much money on both in-park growth and external growth, buying all sorts of independent theme parks around the world. That would be fine if they had tons of cash reserves and a robust business plan on how all these new acquisitions would benefit the company. Remember, Six Flags was making all these growth investments while still having a lot of debt that they were paying off. But at the same time, they weren't effectively paying that debt off because they were in negative cash flow since their acquisition, and they were making all these growth investments under the assumption that nothing would go catastrophically wrong. Following the events of September 11, 2001, tourism declined dramatically. The company's stock took a beating, and attendance dropped off, not ideal for the largest theme park operator in the world, responsible for 37 parks and 47,000 seasonal and full-time employees. Meanwhile, during this downturn, billionaire Dan Snyder began buying stock in Six Flags, quickly becoming a major shareholder. But even with his financial help, Six Flags found itself in a very poor financial situation. After years of capital expenditure in the form of growth and in-park investments, as well as the massive amount of debt Premier took out to buy the company, Six Flags continued to have one bad season after another in terms of attendance. Their year-over-year sales were stagnant and even declining, with their net losses mounting. By 2004, the company had lost over $460 million. But that wasn't even the worst part. Worse was that the company was in over $2.3 billion in debt, making enormous monthly interest and debt payments. So, instead of continuing the trend of growth, they began to downsize. They sold their largest theme park in the world, Six Flags Worlds of Adventure, to their fierce rival Cedar Fair. They also sold off all but one of their European parks, all of which had just been rebranded to Six Flags a few years prior. These sales did contribute to the company's goal of paying down that debt, but the dire straits wouldn't end there. Investors, mainly the two largest shareholders including Dan Snyder, were not satisfied with the company's current trajectory, and they started a proxy war within the company, demanding change and seats for themselves on the board. Dan Snyder's company, Red Zone, ultimately got its way, instituting sweeping changes with a new board of directors and a new CEO. But the company was still in a bad position. In 2005, Six Flags New Orleans had just been hit by Hurricane Katrina, essentially destroying the entire park. Six Flags was not in a position to save the park, and it was ultimately left abandoned. The same fate befell Astroworld in Houston, Texas. Despite ranking as one of the highest attended parks in the chain, Six Flags decided it would be more cost-effective to close the park permanently and just demolish it. Six Flags ultimately sold the land for $77 million in 2006, but only after spending $20 million to demolish it. The new corporate strategy was to focus on families and move away from teens and adults, though that was somewhat challenging as they had already spent millions building headlining attractions for that demographic. Overall, a higher emphasis would be put on customer service and cleaning up their parks, which had declined quite significantly over the last few years. At least they had some truly sensational marketing during this time. Still, the company continued to sell off its properties, but this did little to deter what many saw as an inevitability. Six Flags even stated in their 2008 annual report that, "There is substantial doubt about our ability to continue as a going concern unless a successful restructuring occurs." They went on to say that there was a high likelihood the company would file for Chapter 11, as they ended the year with a little over $1 billion in revenue, though posting a $112 million loss. Their stock price sank to under $1, leading Six Flags to be delisted from the New York Stock Exchange. With the recession weighing heavily on their consumer base, the company reached a critical point. After failing to make debt payments, on June 13, 2009, Six Flags filed for Chapter 11 bankruptcy protection. At the time, Six Flags was in a little over $2.4 billion worth of debt. The company quickly announced they would restructure in hopes of emerging as a brand that would actually make money. The first line of action was to drop their lease for Kentucky Kingdom. By April 2010, a judge approved the company's new plan, with new investors coming in and providing cash while Dan Snyder was ousted from the board. Their stock would be relisted on the New York Stock Exchange at around $9. This new cash from investors would pay off approximately $1 billion worth of their existing debt, definitely a better place to start from. So, with a new plan for the future to cater more to the family market, the company officially emerged from bankruptcy on May 3 of that year. Things were actually looking good for the company after this. Six Flags now had 19 parks across North America, and by 2014, revenue had consistently increased to $1 billion. That year, they actually made a profit. As a result, their stock was also up, climbing 300% since they were relisted. Once again, though, management thought it would be best to start expanding. After all, it wouldn't be corporate chronicles without the prospect of infinite growth, right? The company signed a deal with a development partner to build Six Flags parks in China. In fact, the company was planning a significant presence overseas, planning up to 10 parks in China, a water park in Vietnam, along with a park that was in various stages of development in Dubai. This would be Six Flags' growth strategy moving forward, almost entirely international. Domestically, they saw little growth aside from a leasing agreement for Frontier City and Darien Lake in 2018, plus a few water parks. However, domestic revenue was pretty solid, with a healthy net income and 20% margins in 2017. But this was also partly due to a lack of investment in their parks. Fans were beginning to get annoyed at how many of the new offerings seemed to lack innovation and vision, often being IP-based, off-the-shelf rides. In fairness, though, they did clean up some of their parks and invest in some new and well-received attractions like Twisted Colossus, Max Force, and the Joker. While their stock price rose, the company then decided it would be a good idea to try and buy their competitor, Cedar Fair. Except they didn't have nearly enough money to commit to their $4 billion bid, instead offering the majority of it in the form of Six Flags stock. Cedar Fair, of course, turned this offer down. It was a very strange move, and this corporate mentality seemed to favor shareholders and stock value above everything else. By 2019, attendance and revenue only climbed 2%, while in-park spending, sponsorships, and net income all had fallen. As a result, their stock took a massive hit, the largest single drop in recent Six Flags history. The new parks that were recently brought on ultimately did little to bolster their revenue, and by early 2020, it was announced that not only was the Dubai park now cancelled, but so were their entire future plans for a China expansion. 10 parks being planned, all with a strategic partner, all dead, and the company would just absorb those losses. That was probably the smart move, as 2020 would prove to be a perilous year for the company. Like all physical entertainment around the world, Six Flags was forced to shut its parks temporarily and, as a result, saw a massive decline in park attendance. By the end of the year, they had posted a net loss of over $423 million. Though attendance and revenue did rebound by 2021, the same year the board elected a new CEO, Salim Bassoul. He began instituting new cost-cutting measures company-wide, and the lack of new attractions would only get worse, all while they raised prices and cut jobs. What really infuriated fans during this time, aside from the $45 regular parking fee, was the future outlook by their CEO on what Six Flags could become. Executives believed that Six Flags was remarkably undervaluing itself in terms of ticket and season pass prices, aiming for Six Flags to be a premium, family-friendly focused experience. To be fair, there is some truth to that, so those prices went up. But they did so without adding anything of substantial value. Focus was put on seasonal events, something corporate could easily put together, instead of actual rides, which is what most critics claimed would be the real way to bring back their fans. It makes sense, it's pretty risky to significantly raise the price for a product while giving the same experience. Six Flags was nowhere near a premium Disney or Universal-like product. The result of this was pretty devastating. Between 2021 and 2022, attendance across all their parks fell 26%, from 27 million in 2021 to just 20 million in 2022. As a result, revenue and net income fell to 9% and 16% respectively. And once again, Six Flags' debt crept back up to $2.3 billion. This was a brutal decline, as it showed fans were not returning as executives had hoped, and Six Flags would continue its streak of entertainment and financial underperformance. Remember, this was a time when most people should have been eager to go out to theme parks, post-pandemic. For comparison, Cedar Fair had an overall attendance of 19.4 million people in 2021, but they saw a massive increase to nearly 27 million guests in 2022, and this was all while Cedar Fair has 4 fewer parks. Six Flags numbers were just completely reversed. Clearly, turning Six Flags into a premium destination without giving the parks anything tangibly premium was a complete miss, and once again, the company was struggling to figure out what the path forward would look like. 2023 was shaping up to be another rough year for the company, with attendance and in-park spending down across the board and little new attractions to show. Many didn't see any reason to return to a Six Flags park, especially since it was so much more expensive. The company was in a declining situation, one which had brought its overall market valuation down to a point where a merger was possible. In a move almost nobody saw coming, on November 2, 2023, it was announced that Cedar Fair, Six Flags' longtime competitor, were going to join forces and merge the two companies. It was marketed as a merger of equals, bringing the two regional theme park giants together as one $8 billion company. Cedar Fair and its investors were going to have controlling shares over the company, owning 51%, with their CEOs staying in their roles. Six Flags would retain 49%, and their CEO would be elected to chairman of the board. This merger would retain the Six Flags name. While it did seem to come out of nowhere, it's clear Cedar Fair saw that Six Flags was struggling. By combining forces, they would now have a strong grasp on most markets across North America, bringing their total number of parks to 27 with an additional 15 water parks. By combining corporate oversight, they claimed they could save around $120 million in 2 years. It will also free up over $800 million in cash flow, which they could then presumably reinvest into Six Flags parks and bring them up to a higher standard that Cedar Fair parks had been enjoying for years. Perhaps then they can make the existing Six Flags parks both profit centers for the company and parks that are once again attractive to fans. On a side note, it's puzzling why their merger investor booklet featured AI-generated photos on its covers. One might wonder if they were truly short of amusement park file photos, as the result was rather unappealing. Obviously, the road to get to this point for Six Flags has been, shall we say, an unmitigated mess filled with terrible decisions that ultimately led to a maybe positive ending. But it's been a long and tumultuous journey to get here, with billions of dollars lost, bridges with their customers being burned, and several parks either lost on the drawing board or simply lost to time. Even from the very start, Six Flags was never meant to be a long-term company. It was created as a profit center so a businessman could just replace it with an industrial park. But even when it proved to be more than just a fad, the company would never stay with one owner for long. Executives and major shareholders would continuously swap in and out, a never-ending series of buyouts and new management. While Six Flags did do a lot right and did innovate and build genuinely great regional parks, they also made a ton of terrible decisions that always seemed to lose more and more money. From the excessive and costly expansion plans to the loans taken out to acquire the company, to the later lack of investment, Six Flags has simply been an exhausting company to keep up with. I'm sure there's so much more that I'm missing here, but all of this led to the largest theme park operator in the world and one of the most recognizable names in entertainment to ultimately declare bankruptcy. But now there is hope for the future as capable executives are at the helm, and maybe that chapter of tumultuous days for the company is now over. Perhaps the future of Six Flags might actually have a happy ending.